Hey everybody, this is Peter Hafner, Certified Financial Planner and Certified Financial Fiduciary. And today it's the beginning of June in 2026. And mostly I'm reaching out to our clients today because I want you all to know that we've made some changes to our investment portfolios just recently. And I just wanted to give you a little bit of an update on that. And short story is the stock market's been doing really, really well lately. Last year was a good year. S&P 500 was up something like 16%. The 2 years before that were really good years. The market was up 23 and 24%. And even this year, the S&P 500 is up, I don't know, something like 6 or 8% so far this year, midway through 2026. So the stock market's been doing well. Our investment portfolios have been doing well, and that's great. And what that means is we've been in the right places. We've had our investments, I would say, really well placed to benefit from the rising markets we've seen over the last few years. Even though things have been good, one of the challenges now is that stocks are more expensive than they used to be. So some people will make the argument that, well, the easy money's been made, right? And it's going to be harder to do well going forward. But having said that, the economy still looks pretty good. Company profits and forecasts for company profits still look good. The U.S. is doing better than most economies around the world. And, AI is the big topic, right? We keep reading about AI. And AI and other new technologies, they're really helping businesses grow. I'm finding that in my own personal life as well as in our business. Let's talk about the Fed a little bit. Inflation's been up a bit, but that's because of oil and what's going on in the Gulf right now. And that's worrying. I hope we can find a way out of that in the not too distant future. I think most CEOs don't think it's something permanent, and they're not really worried about it right now, and I hope that's true. The Federal Reserve, that's getting, people were hoping interest rates were going to come down, and they were hoping with Trump's new pick in place, in power, that would be more likely. But there's still mixed opinions about whether the Fed's going to lower interest or not. So we're being a little more careful with our investment portfolios. We still like stocks, especially tech and AI and U.S. companies. But we have pulled back ever so slightly from some stock sectors. So what does that mean? It means we're sort of selling high in some areas and pulling back a little bit, and then repositioning some of those proceeds into other areas where we think there's more potential. We haven't made really big changes, but we have made some small changes. So I equate this to like a sailboat. If any of you ever sailed a sailboat, we want to keep going in the right direction. We want to hit the port, which for us is a safe and happy retirement, right? We want to have good returns without too much risk. So you've got to adjust the tiller and you've got to adjust the sails periodically to stay on course. You don't have to buy a brand new boat. You don't have to abandon the boat, the investment portfolio. And that's what we're doing. We're just tacking a little bit more to the left or the right so we can get you where you want to be, which is a good, happy retirement where you don't have to worry too much. So the main message is things are still good, but stocks aren't as cheap as they used to be. Then I feel like we're in a good position. So if you've got questions or you need some help, just reach out to us and let us know. And other than that, thanks for joining us today, and I look forward to seeing you next time. So long.